naturally, what benefits beyond the conservation of capital do these companies derive when they do business with you?
Yeah, and it's a reason a lot of companies will come to us if they've got more of a tax need, or perhaps they've paid a lot in tax and they don't want to do that again the next year. Under the equipment lease, it can be structured in such a way that it will provide significant tax benefit to that business owner in that tax year. And that benefit comes two different ways. So the basic lease agreement, the operating lease, the fair market value, the typical lease, for most people, they're going to write that off on their taxes the same way they would if they were renting office space. So you don't own that asset, you're renting that asset, it's a monthly operating expense for you, fully tax deductible. So let's take that $10,000 example. And just for ease of math, you've got a $300 a month payment. If you're in a 30% tax bracket, that means 30% of that $300 payment is directly tax deductible. That's $90 tax deductible. So your effective after-tax payment is $210 on that monthly payment. That's a negative interest rate.
Yeah, it's not only how much you make, it's how much you save. It's how smart you are in the deployment of those financial assets.
It truly is. And the small business owner, I think a lot of people, when they get into business, they don't fully realize the tax potential, tax burden that they're creating for themselves. I mean, we all go into business to make a profit, right? We don't always get to do that, but that's the intention. So you need to set your business up to be prepared to make that profit. And there's a number of tools that you can use around financing, around equipment financing, to accomplish that. The other one is Section 179, and ask your accountant.
Oh, here we go.
Section 179. And my background's an accountant, so excuse me if I get a little too geeky here. But Section 179 is a section of the tax code. It's been around for a long time, but part of the Economic Stimulus Act after September 11th, they took the Section 179 deduction and they increased it significantly. It used to be $25,000 a year. Today it's $250,000. And under Section 179, with some qualifying limitations, a small business owner can expense the entire amount of equipment that they acquire in that tax year. So if we use our $10,000 example again, if we structure the lease correctly, and typically you're going to want to have a stated purchase option instead of that open-ended, $1 or 10%, you as a business owner can expense the full $10,000 for the equipment you acquired this year, straight right off of your taxes. But you're paying for it over the next 3 years. So you're buying a tax credit today that you're paying for over the next 3 years. And basic accounting, basic finance, it's the net present value. Something is cheaper today than it is. It's the basic net present value principle that a dollar today is more expensive than a dollar is 3 years from now. A dollar 3 years from now is mitigated by inflation, all kinds of other things. So
the unknown.
The unknown, exactly. The idea is save your money today. And with Section 179, as a small business owner, you'll pay less taxes today.
Well, sure. And the more that you're able to conserve in that year, the more you've got to grow for next year and the next. It's just the compounding effect.
Absolutely,
So, yeah.
absolutely. And I'm sure we'll talk about this, but debt is always cheaper than equity.
Oh, absolutely. You know, we talk about conservation of capital, but conservation of ownership is also very important. And I think you've had some experience with that with some companies, haven't you?
We have a number of companies. There's a very famous famous burrito chain, national. They've come on the scene in the last 12 years, and I'm sure pretty much everybody would know of them. This particular entity, they started in Colorado. Very successful concept for their fresh Mexican concept, primarily burritos and tacos. We engaged with them on their stores 7 through 25 before a private equity firm came in and actually bought out a significant portion of the ownership. During that early ramp-up period, we were able to provide debt financing to them for every store that they opened. So it's approximately $300,000 per store, and it was, the kitchen equipment, the service equipment, and the counter equipment. That customer had a choice. They certainly could have gone out and raised some capital for their company and given away ownership. And at that time, they were valued at somewhere around $5 million. So had they given up 20% ownership for that capital, that's a certain cost. By the time they exited and sold out to the private equity firm, they were worth about $100 million. So if you were to give up 20% of your company when you're worth $5 million, and later, what's the cost of that 3 years later when you're worth $100 million? 20%, that's $20 million. So conserving your equity, conserving your ownership in the company is a valuable thing to do, and using debt is a very strategic way to accomplish that.
So you allowed them to grow from that store number 7 to store number 25. You allowed them to grow without giving up as much equity.
Exactly.
And then later, when they reached that 100 million point, they gave up less equity.
Right. Well, and their equity was worth more. So,
worth more.
So that 20% that they didn't give up early on was worth a heck of a lot more when they sold it 3 years later.
Okay, so they were able to maintain 100% ownership until they got to that point.
Exactly.
That's
Exactly.
beautiful.
Unfortunately for us, when the private equity firm came in, they came in with a lot of cash. There wasn't a need for debt financing. That's what equity companies do, is they want to infuse cash in return for the equity. It was a great relationship, and we've done business with some of those principals as they've gone on and done other things in different industries.
So did you get any free burritos out of the deal?
I did, yeah.
Good.
Yeah, and I had a great reason to fly to Colorado every ski season.
Oh, excellent, excellent. I like that.
Yes.
Yeah. Okay, well, we've got some more segments, too, that we want to talk about. So stay tuned, and we'll get to those in just a moment.
Got that wrong. You're going to have to edit that one. Something is more expensive.
This is live
Basic. This
TV.
is basic. My SDSU finance professor just slapped me.
We're going to let that one out.